Most people think the biggest investing mistake is choosing the wrong thing, the wrong asset, the wrong opportunity, the wrong time. But that's not the mistake that quietly destroys most people's money. The biggest investing mistake is something far more subtle, something almost everyone does, and most people never realize it while it's happening. It has nothing to do with what you invest in. It has everything to do with how you think about the investment after you've already committed. Imagine this. Someone puts money into a small business idea, not a huge amount, just enough to matter. At first, everything feels exciting. There's optimism, possibility. Then weeks go by and progress feels slow. No disaster, nothing obviously wrong, just silence. And suddenly, doubt shows up. They start questioning the decision, wondering if they should have waited, comparing themselves to others who seem to be doing better. Nothing has actually changed, but mentally, everything feels different. That moment right there is where the mistake begins. Not because the investment failed, but because the person starts needing reassurance. Here's another situation. Someone buys a piece of property. They planned for the long term, but soon after, unexpected costs appear. Repairs, maintenance, delays. They knew this could happen, logically, but emotionally, it feels uncomfortable. They start checking numbers more often, rerunning calculations, asking themselves if they made a mistake. The investment hasn't failed, but emotionally, they've stopped treating it like a long-term commitment and started treating it like something that needs constant validation. Another example, someone invests time and money into learning a new skill, a course, equipment, months of effort. At first, motivation is high. Then, results take longer than expected. They start wondering if it was worth it, if they chose the wrong path, if they should switch to something else. The problem isn't the investment. It's the mental shift from commitment to constant evaluation. These situations look different on the surface, but underneath, the same mistake is happening every time. The biggest investing mistake nobody talks about is this. People expect investments to provide emotional comfort in the short term instead of accepting uncertainty as part of the commitment. That expectation quietly changes behavior, and behavior is what determines outcomes. Most people don't lose money because they chose poorly. They lose money because they can't sit with uncertainty. They need feedback, they need reassurance, they need signs that they were right. And when those signs don't show up quickly, they start interfering. They adjust, they hesitate, they second-guess. They don't give the investment time to work. Here's the uncomfortable truth. Any real investment, money, time, effort, requires a period where nothing feels certain. Progress is invisible, results are delayed, confidence is tested. But instead of accepting that phase, most people try to escape it. They want clarity where none exists yet. So they act. And those actions are usually driven by emotion, not strategy. Think about how often people check their investments. Not yearly, not quarterly, constantly, even when nothing meaningful has changed. That checking isn't about information, it's about reassurance. And reassurance is addictive. The more you seek it, the harder it becomes to operate without it. This is why even intelligent people make poor investment decisions. Not because they lack understanding, but because they underestimate how uncomfortable uncertainty feels. And the brain is wired to reduce discomfort, even at the cost of long-term success. Here's another scenario. Someone invests in a side hustle. They put in money, time, energy. At first, the excitement carries them. Then growth slows. They start asking questions. Is this still worth it? Should I pivot? Am I wasting time? Those questions aren't bad, but when they come too early, before the investment has time to mature, they create damage. Because instead of letting the process unfold, the person keeps resetting the process. And constant resetting destroys compounding. Compounding only works when something is left alone long enough to grow. But most people interrupt it, not because they need to, but because they feel uncomfortable waiting. Here's what almost nobody explains clearly. The hardest part of investing isn't choosing. It's staying mentally consistent after you've chosen. Anyone can make a decision. Very few people can sit with the emotional discomfort that follows. This is why people abandon investments too early. Not because they failed, but because they didn't feel good while waiting. They confuse emotional discomfort with failure, and those are not the same thing. Let's be honest, most people don't want investments. They want results. They want results without the period of doubt. But the doubt phase isn't optional. It's the price of admission. Here's where this mistake becomes really costly. People don't usually make one big emotional decision. They make many small ones. They tweak, they adjust, they pull back slightly, they hesitate a little longer next time. None of these decisions feel dramatic, but over time, they change the trajectory. And eventually, people look back and say, I should have just stuck with it. Notice something important. Successful investors don't necessarily have more confidence. They have less emotional involvement with short-term outcomes. They don't need constant reassurance to stay committed. They accept uncertainty as part of the deal. This applies to everything: money, real estate, businesses, skills, time, any situation where results take time. Here's a simple test. If you constantly ask yourself, was this the right decision? You're not evaluating the investment. You're seeking emotional relief. And emotional relief is a terrible decision-making tool. The market doesn't reward emotional comfort. Neither does business, nor learning, nor long-term projects. They reward patience, and patience is uncomfortable by design. Once you understand this mistake, something changes. You stop looking for signs every day. You stop reacting to noise. You stop mistaking discomfort for danger. And that alone improves outcomes more than any tactic ever could. The biggest investing mistake isn't choosing the wrong thing. It's expecting certainty in a process that doesn't offer it. It's treating investments like they should feel good while they're working. They rarely do. Most people lose not because they failed, but because they couldn't tolerate the waiting. And once you see that clearly, you stop sabotaging yourself in ways you didn't even realize were happening.